Hi, Tamal. Welcome to the Business Standard Banking Show. This week, we are talking about the RBI's new personal loan norms. It has raised the risk weight. Now, can you tell us a little bit about this instrument that RBI has used?
Thanks, Ruchika. I mean, this is not often used by the central bank. Technically, it's called a macro-prudential way of facing or tackling certain problem. What is mean is this, for every 100 rupee loan a bank or NBFC given, provided if its risk is 100%, which means it needs to keep 9 rupee of capital. Now, when you raise the capital adequacy ratio or the risk weightage from 100 to 125%, which is 1/4 extra, means for instead of 9 rupees, it needs to keep 11.25 rupees, be it Reserve Bank of India or an NBFC, which has been giving such loans. So essentially, making its capital more expensive, and that will reflect in the cost of the funds. The loan rates will go up. That's the first step, the impact of that. And RBI historically, RBI has used it. Dr. Reddy made it actually in the run-up to the global financial crisis. He used it for particularly mortgages, later personal loans.
Now RBI has used this before, and in your column, you've said that RBI does not want to take a chance when it comes to unsecured small loans. What do you think is making RBI so wary? What are the concerns?
Now, if you look at the number, the personal loans, retail loans have been going up. Within retail loan, the personal loan is going up, and within personal loans, the unsecured loan up to 50,000, between 10,000 and 50,000. There are two slabs up to 10,000, up to 50,000. They have been growing pretty high in the past few years, last 2 years, and every quarter we are seeing more such numbers. And also the delinquency, people's inability to pay up the service, the interest for 30 days, 60 days, and 90 days have also going up. And other part is this: they are mostly coming from non-cities and the smaller places. So all this combination, it seems to be a cocktail of bad omens. Not exactly. So the regulator is not excited about it. It had been issued warning to the banks and NBFCs hold on to it. But ultimately, banks were not holding on, or NBFCs not holding on. That prompted Reserve Bank of India.
Now, there is obvious talk of the fallout of this move for fintechs, NBFCs. But more importantly, there is a fallout for the borrowers. What do you think of the impact it will have on the borrowers?
Absolutely. Before that, just one line on fintechs and NBFCs: their cost of borrowing will go up, so they have to charge higher, and essentially you see that they need to be capitalized like tier 1, tier 2 capital, so their cost of funds will go up. That's the part of it. So the borrowers need to pay more. Now, what will be the impact on the borrower? That's the most critical part. Now, you see, this is not personal loans is not a luxury item. Like you don't take personal loan, you take personal loan actually for survival. My understanding is this: after the COVID fallouts, people losing jobs, and not exactly things are going the right way for the people of the bottom of the pyramid. Probably they have been taking their personal loans for the genuine reasons. Now, if that is the case, even if the loan rates go up, they will have to take them, or otherwise they will go back to the money lenders. That's the situation. Now, the other option, the other way of looking at it could be these loans were not going for actually general requirement. This loan was going for speculation, so investment in stock markets, etc. If that is the case, then definitely it's a right step the regulator has taken. It will have an impact on inflation. It will have an impact on market, etc. But if it's the other way, people have been taking actually for their livelihood and to survive in this kind of scenario where the things are not exactly rosy for the people of the bottom of the pyramid, then I'm afraid things will not be good for the economy. People will, because they will now turn to the money lenders. Or even if the banks and NBFCs are raising their rates, they will still have to, their cost of borrowing go up, and their pain will even aggravate.
So on the positive side, RBI is obviously hoping, as are we, that this will have some positive impact on inflation. But as you very rightly pointed out, for the genuine borrowers, it means that the cost of borrowing goes up and the return to money lenders is not a good news for the economy. Thank you so much, Tamal, for discussing this very important issue with us today. We'll see you again next week.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.